Our next guest still sees a high probability of a recession over the next 6 to 9 months. On private equity, he says it's an outperformer over nearly every period of time, especially during periods of economic turmoil. Joining us is Scott Sperling, co-CEO of THL Partners. What started to get me words, Scott, was yesterday I was saying the Fed, did they really stick a landing? Did that really happen?
It would be the first time ever.
That's what I mean. And the way it wouldn't work is if the excesses that we all talk about over the past 10 years, all the easy money, whether we're not finished dealing with that, whether we're not, whether this isn't, maybe this is just the first series of rate increases, because you and I were both around for 8% 10 years, right?
My first mortgage, our younger partners laugh because it illustrates my age, but my first mortgage was 17%. So in the world of rates, this is not horrible. This is still below the long-term 40-year averages for rates. So I think that there's a reasonable possibility that no matter what, rates are going to stay within this range.
Would that cause the recession? Would that cause it that you're talking about? Or do they have to go higher? Will they have to go higher?
I don't think it's the rates themselves. I think it's a whole confluence of things. So we had an enormous influx of money into the hands of consumers through various forms of fiscal stimulus. I think Rob Kaplan has pointed out that there's still a lot more, or there has been a lot more of that in people's pockets than maybe had been expected, and that helps account for some of the consumer spending. We're seeing record credit card debt at rates, if you can't pay it currently, of over 20%. We have a situation where some of the drivers of growth that we've had over the course of the last few decades, and the drivers, the anti-inflationary drivers, are all dissipating. So globalization helped bring down the cost of everything. We're now deglobalizing. Maybe very good reasons for that, but there's a price to be paid. The impact of China slowdown is pretty significant for corporate growth, because for many companies, that is one of the key parts of their growth strategy. So I would expect that there's going to be a number of factors that may lead to a recessionary period. Soft, hard, I think it's painful regardless. To the average person, that tends to be a painful period.
Well, the inflation that you're describing, and I do see a lot of reasons, and we've talked about it in light of industrial policy, that we need to bring chip manufacturing back here, but it's going to be more expensive. We know that. We need to go to renewable energy, but it's going to be more expensive. So
all those things are true, and again, it all leads to it's going to be more expensive.
Will that mean higher rates down the road? Are they going to be higher than 4% on the 10-year? Will we go 5 and 6?
I am not that smart. Okay. I don't know. I think that we should expect, though, that it is
we're expecting cuts next year, Scott. Is that
well?
coming?
That's what the market's expecting. I think the market, the last I heard, is trading pretty close to 20 times, which is higher than normal. And I know that there's this issue of the concentrated performance of handfuls of companies, so others are not benefiting quite as much, which again is problematic from a...
But all these inflation drivers, do you think that this leads to structurally higher inflation, and so the Fed's 2% mark should actually be adjusted? Or is this a temporary, inflationary boost?
I think that inflation for at least the intermediate term is going to be more in the 3+% range because of these factors. And could be bouncing around between 3 and 5%, depending on shocks to the system, which we have seen that can impact particularly energy prices. The other element that you have to take into account is the way to deal with some of the wage inflation pressure, which I think will not abate. I think we're going to be looking at wage increases in the 3 to 5% range for a long time, is through automation and productivity. And those things will have some benefit. And again, there are technologies out there that we don't yet know exactly how that fully plays out. Clearly, generative AI is one of those things, but lots of other technologies.
So why do we need private equity? What do you guys do that's so great? You you rationalize operations and cut the fat. So
I think there are a lot of different strategies. The one we have, and I think a lot of folks have, is that you try to find a good company in a really attractive area that may have the ability to perform better than it's currently performing.
If you fire a bunch of people.
Sometimes it's hiring a bunch of people. Because a lot of companies aren't taking full advantage of their ability to scale into new ways of going to market. We buy a lot of companies where we add chief revenue officers. We add a lot of people who can expand the revenue generating capacity of those companies. We don't tend to buy large manufacturing companies, so cutting people isn't as much of a
rationalization. But you're doing God's work in your view.
As a God-fearing person, I would not put it that way, but
I could see how you could see.
Joe, I could see how you can view it that way.
You're a benefit to society, and over time, that's how we intro the segment. Your asset class outperforms most other, and at 20 times earnings, this might be something that people that can afford to should look into.
Well, again, I think particularly if there's problematic economic cycles, we've tended to do even better on a relative performance basis. But the model of private equity, I think, does work through most environments.